Welcome to the tankers session, the last of our ship type sessions this morning, I think. We've already had some very interesting discussions around the other ship type sectors, and I'm delighted that the organisers have been able to put together such a global representation of the industry. Not just a very strong showing, of course, from the Greek sector, but also covering from Connecticut to Beijing. So welcome to all our panelists. Just to introduce myself, my name's Nick Brown. I have the pleasure of leading Lloyd Register's global marine and offshore business. And perhaps I can just start by asking our panelists just to give a brief introduction to themselves and their companies. Perhaps starting with Jerry.
Thank you, Nick. I'm the CEO of Capital Product Partners, a master limited partnership that was listed in 2007. Today, we own a total of 36 vessels. It's a diversified fleet across product tankers, crude tankers, containers, and one odd dry bulk vessel. The common characteristic among all these assets is that they are on period charters, giving our unit holders cash flow visibility, and we have been able over the last 10 years to pay in excess of $750 million of distributions on the back of these period charters.
Good morning, everyone. Vassilis Kertsikoff, Vice Chairman of Eletson Holdings and Chairman and CEO of Eletson Gas, which is a joint venture with the Blackstone Group on the gas side. So primarily tanker exposure, but also a sizable gas fleet in non-VLGC sizes. So happy to be here again. Thank you.
Good morning, everybody. I'm Daniel Xu from ICBC Leasing, and it was my honor to have this opportunity to introduce you to our tanker department as well as ICBC Leasing. ICBC Leasing is the first financial leasing company in China, and recently we are quite active in the shipping finance sector, almost in every segment. So we are Greece is always the target country for our company, and we are always looking forward to cooperate with your respected company. Thank you.
Good morning, everyone. I'm Valentis. I'm the CEO of Pixies Tankers. We are a pure-play product tanker company. We specialize in medium-range size. We are a growth company. We are listed at NASDAQ, and our ticker is PXS.
Good morning. My name is Bob Burke. It's great to be back here in Greece, especially with the weather cooperative this Posidonia. I'm the CEO of Ridgebury Tankers. We have VLs, Suez, and MRs. We're backed by Riverstone as a private equity group in New York, and also some other private equity groups. But we have a full complement of operating and technical people.
Good morning. I'm George Saroglou. I'm the Chief Operating Officer of Tsakos Energy Navigation. We are a very diversified tanker company with a big footprint in tankers and products, and also a participation in LNG and shuttle tankers. Thank you.
Thank you all. So since our last Posidonia, the tanker market has possibly suffered the most challenging developments, with rates being possibly as low as they could be, particularly on the crude side. And whilst we've seen some recent signs of recovery and VLs edging in some routes towards world scale 50, we've also seen so far in 2018, I think it's fair to say, record levels of scrapping, high scrapping rates, but we've also seen some continued new build activity, and crude oil order book now up at 13%, the product market at 8% of the existing fleet. So perhaps I can come to Bob first, and we just start by examining the demand side. We have seen some, let's say, encouraging signs around oil prices, perhaps much more encouraging than people would have expected just at the beginning of the year. Oil prices reaching $80 a barrel in recent weeks, 3.5-year highs. Bob, some of that, of course, down to unexpected volume decreases in Venezuela. But what do you believe are the short-term demand recovery outlook for the crude sector?
That was for me?
Yeah, please,
okay.
Bob.
You know, I was talking to someone yesterday, and they said, it's a funny market, isn't it? I said, what's so funny? I mean, it's horrible. You talk to any owner, and, you know, we're bouncing along at some small premium to operating costs, especially on the larger ships. And, you know, the market always has to right itself. It's very fragmented, a lot of different owners. You can feel the pain when you talk to owners across the board. And you know, we're eternal optimists, otherwise we wouldn't be in this business. But what we see is, you know, a lot of pressure on scrapping on the larger size vessels, especially the Vs. You know, roughly 30 have been out of the market this year. In the real short term, we've seen a lot more crude coming out of the U.S. Gulf from the Chinese. I guess it's attributed to two things. Number one, the WTI Brent spread, and number two, supposedly the Chinese want to somewhat correct the trade balance, at least for, you know, cosmetic purposes politically. So in the short term, we see continued stress. There are still, pick a number, 30, 40 too many VLs out there, and the Suezes are, you know, somewhat better. You know, it's a more fragmented market as far as demand goes, and you know, loading ports and discharge ports that can right itself a little bit easier. But we don't see any significant improvement over the next 6 months. I mean, we're hopeful for this winter, as we always are. We're saying things will correct on Thanksgiving Day, but that's more of a hope than a prediction. So, you know, we're not highly levered, but we feel the pain like everybody else.
Okay, George, Vassili, any comments you'd like to add?
I'd like to say that on the demand side, I have to agree. We have gone through 4 very strong years with demand growth at least 1.5 million barrels per day, which is significantly above the long-term growth trend, which is between 1 to 1.1 million barrels per day. So demand is there to support the market. The order book has been, you know, we're absorbing the order book, and I think we are at the end of, you know, absorbing this. The numbers of the new vessels that have entered the fleet in the last 2 years. We have some new trade routes developing thanks to the U.S. export of crude, which was not something that we had a few years back. And I think with the geopolitical risks and the OPEC decision in the next month coming out, which most probably points out to a relaxation in the cuts, I think the stage is there to see a recovery in the tanker freight rates, especially for crude carriers.
I just want to add, Clarkson's Plateau put out a paper a week or 2 ago, and it showed that every time that OPEC opened the spigots, between the time they did it and a year later, rates increased 100%, 150%. And I think that's where the biggest benefit lies, and couple that with the Iranian fleet that could possibly be laid up or put in storage, it could be a good year next year.
I would look at, from a demand point of view, I would look at geopolitics as playing the biggest role in the next few months. I think it's very important what happens with Trump and Iran, and it's also very important what happens with Venezuela. If Venezuela further implodes, that's a big plus or minus in the market, and Iran, of course, is a very big factor. So I think the eyes are on the Iranians and what happens with Trump, and I think that would be the swing factor on the demand side for the short term. But I agree with the previous speakers that, you know, the problem in tankers now, in bulkers a couple of years ago, in containers, whatever, you know, always in shipping has been supply. So it's never been a demand problem. It's always been a supply problem. To the extent that the supply in tankers is getting normalized or even below average growth, that's very good for the next couple of years.
Okay, thank you. Maybe I just bring Daniel in here. We've seen, obviously, rumors now with OPEC meeting coming up in a few weeks from Saudis and Russia talking about possible increases up to 1 million barrels per day. Daniel, where's your slant on this from, the demand in China, and your insight from that and how that might drive trade pattern development?
Well, if I may, and take a step back to what we said earlier, and I think it's very relevant to to the issue of OPEC. In the end, as tanker owners, we are in the volume business, and actually the volume business being transported by sea. In order to understand the market today, you have to see what happened over the last couple of years, setting supply aside, with regard to oil prices and inventories. So OPEC decided to, together with Russia, to cut oil production in order to prop oil prices and, which obviously connected, take down inventories which were bloated. So today, when you look at inventories, they are close to historical averages. At the same time, oil prices have doubled, but from a very low point. So actual demand destruction is very little. The IEA is expecting only 100,000 barrels to be saved off their growth projection. So for OPEC, together with the Iran situation, it is a very good opportunity to start turning the tap on. And I do think that if this happens, and some say that it has already started happening, that OPEC, let's say, compliance has come down. Don't forget that OPEC compliance a couple of months ago was at 170%. So actually, OPEC members were producing even less than their quotas, be it because of their production problems or simply decisions taken by the Saudis in order to help oil prices. So as OPEC oil flows back into the equation, I do think that this could be the inflection point for crude tanker markets if you also look at the supply side. I don't think this will mean necessarily from one day to the next a market that we will see sky-high charter rates, but probably the second quarter, and we do hope that this is the case, will be remembered as the low point. And potentially towards the end of the year, early next year, we will see more reasonable earnings. And potentially then in 2020, supercharged by the regulatory impact, a much healthier tanker earnings environment. So my guess would be that OPEC will increase production going forward, maybe not to the extent that many players expect, but it should be the start of increased volumes.
Thanks, Jerry. Daniel, I hope you don't mind me pulling on you to represent, let's say, China and their demand for imports. How is that and these geopolitical developments influencing ICBC's planning?
From my understanding, I think the most benefit market will be from the crude oil market, and also we are trying to import more energy from the US. So for these routes might be benefit, but as something has changed in China, as you may see, there are so many electric cars in the street of China. So in the long term, the oil market might not grow as fast as in the past. So from my understanding, because most of my friends told that for the first cars, it will be diesel oil cars, but for the second, they will definitely choose electric cars. So we are definitely will import more from the US in this area, but the total volume may not grow as fast as before.
So given this rather complicated development pattern, Is any of the panelists willing to bet on where they think the biggest winners and losers on the trade routes are going to be? Trade route winners and losers?
Trade routes? Trade route?
Trade routes, yes.
Well, there is one obvious one that looks like Iran, at least in the short term. I mean, last time around that secondary sanctions were imposed, the Iranian oil production fell from 2.1 million barrels to 1 million barrels, almost overnight. So that's one definitely that's going to happen. And then, of course, you have Venezuela for the reasons that we all know. But I think what we do underestimate is the fact that across the globe, with maybe the exception of the US, we have seen a sustained underinvestment in oil production as oil prices were at a very low point for years. So I think you will see that many of the traditional exporting countries, be it Mexico, West African countries, and so on and so forth, will struggle with their oil production going forward, and they lose capacity, while the US should be able to pick up market share depending on how quickly they manage to get the necessary infrastructure for exports.
I think going forward, the next couple of years, the big question mark is how the fuel oil trade will shift, given the regulations on the emission, on the new regulations. So I think there may be big imbalances on bunker fuel, which will affect product tanker rates. But I don't think anybody's can predict precisely how that will pan out. But that's something again to watch over the next year or two, how refineries adapt and how trade patterns change. That can have quite a significant impact.
Yeah, I think there'll be more of this residual fuel coming out of Russia going to the U.S. Gulf because the Russians don't have the refineries to crack it any further, and the U.S. Gulf refineries do. And I think the U.S. Gulf will continue to surprise with the exports over the next couple of years. The infrastructure is being built out fairly quickly. We have a lot of oil that's still bottlenecked in there.
Okay, thank you. Now we've seen, and as I mentioned at the beginning, the low charter rates, particularly in the crude sector, not putting off new investors. Recent orders by, let's say, new entrants such as Apollo, orders just in the last few days by Vitol as traders, going into the Vlsc market. What do we think is driving this continued ordering of new tonnage?
Insanity?
If I may, because putting my Capital Maritime hat on, we have been part of this order book, so maybe it's a little more reasonable than insanity, at least. So the age profile of the VLCC fleet right now is about a fifth of the VLCC fleet is more than 15 years of age. If anything, as you fast forward to 2020, you'll see that this number gets close to 20% of the fleet being more than 20 years of age. At the same time, the global order book for crude tankers, it's a fairly reasonable 12%. Demand, as we discussed, is actually quite robust. There's no issue with demand. If anything, I think the panel would agree that there is increased ton mile. So the problem is supply. Today, you have seen, year to date, you have seen 26 VLCCs being scrapped, 16 being delivered. So you had fleet contraction. Some of seaborne volumes will be coming back to the market, so you should expect to see more demand, potentially more scrapping. And then you have, of course, the regulatory environment. And if you look at the regulatory environment and what it would mean for older ships, be it because of the installation of ballast water treatment systems, Be it because many of these older ships are very inefficient, and in a high bunker price environment, they will have to be either scrapped or slow steamed. I think the actual supply, the effective supply, be it because of scrapping or slow steaming, by 2020, should be much less than the nominal order book shows. So I think we have a fantastic opportunity for a very good market in 2020. And then when you look at new building prices, we entered when new building prices were around $80 million, despite increases in steel prices, then it was and continues to be a very good investment. So when you look at Vitol, for example, if they ordered the $90 million, that would mean that we are already $10 million in the money per ship. So making $40 million within 6-8 months, not necessarily insanity, but I will wait until we actually take that check.
Okay, Jerry, I'll back off a little bit. Each investment's looked at individually, of course, and I think everyone in this panel will be very happy, and a lot of people in the room, if no ships are ever ordered again. But that's not going to happen. If you do look at the order book, as Jerry said, and it's 12, 13%, whatever you feel the right number is, it's a good time to order. And the prices are historically low. But in our industry, we've always been a victim of overbuilding because, you know, it's the tragedy of the commons. If I'm the only one who orders a ship, it works out really well. And of course, you know, nothing is static in the world or in this market. And the danger is we all see the numbers Jerry mentioned, and we all order, and the market that you thought was going to be there 2 years out is not there. We don't order new ships because we have I personally have a problem trying to predict what's going to happen 2 years out in a market that's volatile to begin with. If you have a large enough portfolios of vessels, then it makes a lot of sense to have a continuous renewal program, in which case the price right now is very attractive.
Daniel, any comments? Where's ICBC's mind on investment in new tonnage now?
Yeah, I think for many of the shipping owners, it seems a good investment right now because right now the new building contracts price is quite low. Considering the steel price in China has increased from 2,000 per ton to 5,000 per ton during the last year after the Chinese government phased out of the backward and redundant industrial capacity of the steel industry. So it means that the steel price is definitely will rise. And of course, the labor cost is also will rise. So it means that from the building contract price is quite impossible for them to decrease. And what's more, from the supply side, and many people thought there would be quite a big amount of scrap. And also the new regulation will make some old vessels become less competitive, and the oil price increase, and it's not good for the for the vessels traded on the spot market. So from their perspective, the asset value is definitely will increase.
If I may, I'm not going to comment on the Vlsc orders, but on the MR orders, if I may.
Please.
We've seen the order book at a very low, historically low levels. It seems the supply of vessels for the next couple of years look very good. The overall order book looks to be at the region of 5 to 6%. Demand for products is really strong, is in the region of 3%. This is projected by IEA. Therefore, we see a very well-balanced market. Shipyards that traditionally have been building MRs are not in the market anymore, so we've seen a limited supply of vessels. So overall, for the sector, it looks good going forward.
Thanks, Eddie. If I could just stay with you then for a moment. We touched already on the 2020 impact and what fuels the world fleet, never mind about the tanker fleet, will be using going forward. Obviously, a very small percentage of the world fleet is going to be scrubber compliant from that perspective. What does that mean for the product tanker demand? Are you betting a peak in rates as we get closer to 2020?
Yeah, it's a very interesting question. Our projections are, of course, that low sulfur fuel demand will skyrocket. The projections today are for an increase in demand of approximately 3 to 3.3 million barrels per day. Therefore, this demand has to be covered by refineries. We don't know exactly if the refineries are ready to support the increased demand. But definitely, it's an interesting story developing for MRs, as this low fuel will have to be transported to the bunkering ports. In the meantime, fleets that include eco vessels will have an advantage over the older units. We believe that slow steaming will prevail, and therefore the eco vessels will have an advantage over the remaining fleet. At the same time, of course, a disadvantage will be that the price per ton for the low sulfur will skyrocket as well, as demand will go higher. So we see definitely a year of disruption, 2020, but things will normalize by 2021. We estimate that demand for product tankers will be high for 2020.
Vassili, George, any comments on that one?
I agree with what the previous speaker have said. With the new regulations, the new fuels that are going to be created, basically we're going to see new trades from the more modern refineries, which we know that these refineries are in the Far East, in the Middle East, to places that where we've seen closure of refineries in the OECD countries. And therefore, this trade of the new products, I think, is going to give a boost for product tankers demand.
Remember the chaos created by Y2K? No, there was none. We're hoping for a lot of chaos, and certainly the world's not ready for the displacement of the fuel oils and the residual fuel. So I don't think any of us know, but certainly the refineries aren't ready for it. I mean, very, very few people put scrubbers on their ships. There'll be some chaos, some displacement. Any of that's going to be good for us, and how much there is, I can't predict.
And we're going also to face technical problems. I mean,
these
technical problems,
absolutely,
which we are already facing in some cases. I mean, I think you all know what happened in Houston a few weeks back, when we had a lot of vessels that have been contaminated as a result of a bad blend. So imagine what will happen when the majority of these new produced fuels will be blended fuels. There's not going to be straight run fuels.
Yeah, there are serious blending issues in the fuels, and also the sulfur in the fuel lubricates different parts of the engine, and when that sulfur is gone, the engines aren't built for this type of fuel. There'll be operational issues on that end too.
Yeah, nothing much to add, except quite a bit of uncertainty and dislocations, which are always good for shipping. But the main point is George's point, which is you have to look, if you're trying to predict, you have to look at the refinery base, which is the most flexible. And this tends to be the Middle East and now India, so versus OECD. So to the extent that flows have to flow to OECD, then that means more ton miles, which is good for rates. Now, whether rates skyrocket, as Eddie suggested, I'm not so sure. But on the other hand, they only ways up from where they are today. So.
And if I may, a final point on this. Something to consider is what happens as we reach 2020 or just a few months earlier. So you have all this onshore commercial storage of heavy fuel oil that potentially will have to be moved to floating storage as demand for this product will fall. Potentially this will go onto VLCCs or Suezmaxes, as it will have to be moved for different types of consumption, potentially power generation. You'll probably see heavy fuel oil go into contango because of the sudden shock in drop in demand. That should favor floating storage even further. Then you might see a big movement just before 2020 of middle distillates. So as storage is being created and inventories are being created for middle distillates. So there should be quite a bit of commotion, which, as Vassilis said, it's always good for shipping.
So Jerry, let me ask you a question then, and maybe others can chip in here. We've seen limited orders over recent years for LR3s. Is this demand for fuel from our own industry likely to see more interest in Suezmaxes carrying products or conversion of existing Suezmaxes to meet that demand?
Well, you know, a lot has been said about LR2s and how they will play into the product tanker trade. But for me, there were always Aframaxes with an option to trade in the product tanker market. So this is obviously the case with LR3s or coated Suezmaxes as well. So far, you wouldn't need any LR3s. The gas oil that was being moved from east to the west was being serviced and still is by Suezmaxes picking up their maiden cargo as they're still clean of gas oil to the west. So if traders have a constant flow of new builds, why would they need to employ more expensive ships? And you know, this is also the first voyage, which means that probably the vessel was not vetted, and so it's a cheap voyage. So all in all, I think you have to see a strong tanker market as a whole, both products and crude, before you see actual demand being created for LR2s and even more so LR3s. Yes, I do agree that the change in the sulfur cap and the changes it will bring potentially will mean more middle distillates being moved and need for more coated tonnage. I think it's going to be good for product tankers. But I think the first ingredient is a good tanker market.
Okay, can I just ask Daniel then to come in here? We touched actually on the previous gas panel about China and the move towards cleaner energy generation. We've obviously seen the car industries in Europe, but also globally, give commitments to move away from diesel. Many of us, I guess, in the room were at a maritime Cyprus where I think Bob was actually on the panel, and it was entitled, "Is there a future for the tanker industry?" Given the car industry's direction. From a China's perspective, Daniel, you mentioned the move more towards electric vehicles. Where do you think this is going to drive product trade going forward?
Yes, as just mentioned, the Chinese oil consumption will not increase as fast as before. During the low oil price period, the Chinese government has increased at least 3 times for the consumption tax of the oil. That's when the oil price is around 30 barrels to 50 barrels per dollars per barrel. So it means that resulting in at least half of the oil price now is the tax. So when the oil price increased to, for example, 80 to 90 barrels, the per channel price is definitely will be much higher than what we have used to. So right now we have quite a lot of electric cars, especially in the city areas. And also the Chinese government encouraged, we are using some alternative energy like solar panel. In my hometown, to install a solar panel on your roof is for free. It means that for you in the next more than 10 years, you can sell the electricity to the state-owned electricity company. It definitely will also reduce the the requirement for the oil. So from my understanding, we right now, from my understanding, so in the long term, we are needing less oil. So though presently we don't limit our lendings to the product sector, but in the long term, we might reduce our portfolio in the whole sector.
I think there was some data from IEA last week. The data was suggesting that by 2030, the displacement of gasoline sales is expected to be from 2.5 to 4.5 million barrels a day due to electric. However, gasoline demand is still about 8 to 10 times of that amount. So yes, electric is playing a bigger role, but we have to put it in perspective. At the moment, electric sales are about 1% of global car sales. That's expected to go to 20% by 2030, driven primarily by China and India. And so that by 2030, about 40% of the fleet may be electric. So things are moving that way for sure, and that's the big elephant in the room. On the other hand, the report was it's very interesting to note in the report that governments were supposed to lose, under this scenario, about 100 billion of annual taxes. As the regime stands today, electric is very heavily subsidized. So there's a dilemma, or there's an offset between increased electric use and continued subsidization of this use, which really is not so untenable given the global consolidation, let's say, of public finances. So it's happening. It's a big question. It's not happening that fast, but it's something to watch quite closely.
Okay, so
if I may, just a final comment. I agree with Vassili, of course, but it's a gradual process. It's not going to happen overnight. In the meantime, let's not forget that product tankers are very diverse. They can carry from veg oils up to diesel. And just for a comment, I mean, last year, our major cargo was veg oils rather than gasoline or diesel. So we have a lot of cargoes that we can carry.
Okay, so in our last minute, other panels have already talked about the tsunami, let's say, of new environmental regulations, possible impact of slow steaming. What do the panel think, maybe in one word, is going to be the biggest disruptor for the tanker market over the next year? Maybe we start with Jerry.
I do agree that the impact of the new regulatory environment is going to be the most important challenge or disruption for us, for shipping. Don't forget that we talk a lot about the low sulfur cap, but in the end, the implementation of the ballast water treatment systems treaty starts really over the next few years, as many of the IOPPs and special surveys come up for renewal. I do think that there is a lot of opportunity because of this disruption, especially for owners that are willing to endorse these regulatory changes and invest in them, and are able to take advantage of potentially energy-efficient ships. Having said that, maybe because I think this is very obvious, and this is not necessarily the case in shipping, it's not that every Posidonia we have such a big, let's say, industry disruptor. What I found interesting this time around is also the digitalization of shipping and how much we have discussed about new technology. This was completely absent from previous Posidonia, and maybe after 2020, this might be also something that will become a potential disruptor for all of us.
About 20 years ago, we had the two-tier market, it was double hulls. I think this new tsunami, as mentioned, has the potential to overcome the double hull impact. Part of it is the uncertainty, part of it is the lead time, and part of it is, of course, is the market being so low. So I think the market has not discounted the possible impact. I think it would be large. We just don't know exactly how it's going to pan out, but I'm very confident that it's going to be a big positive.
I think the question is which of the smaller players are going to survive this tsunami of regulation that is coming. Water ballast, 2020, NOx and particles in 2023. And by small, maybe we're talking about companies that are 1 to 5 vessels, possibly 10. They will have to face some tough decisions, especially in an environment with not too many lending banks out there. So this, and I think the second potential opportunity for consolidation in the tanker industry, we're talking about funds which have been into shipping and are looking for an exit. If they won't be able to exit through traditional ways like an IPO, then most probably you're going to see some of these assets being offered to larger players to consolidate with.
Yeah, I think this natural cycle has some time to play out, whether it's another 6 months or a year. I mean, the hope is, or the probability is that it'll play out just as 2020 starts to hit, and you'll have a combination of effects that create some sort of tsunami or huge change in the market. And it's always the inflection point that we look for. And once that inflection point hits, we should have happy days again.
Yeah, Vassilis mentioned the double hull in '94. I mean, also back then it was phased out, vessels were phased out. This is not happening in 2020. We all have to comply in one day as of the 1st of January. So this will be the major disruptor. On the positive news that we listen is that at least 2 majors are experimenting in blends. Therefore, that might be good news for next year. But also for as far as we're concerned, this is the major disruptor for next year.
From my understanding, the most disruptor will be Mr. Donald Trump's policy against other nations. And in the long term, maybe he will be the next president again, so it's maybe not good for the shipping industry. For the long term, I think the technology. Right now, we are talking about the intelligence ships, and it definitely will change the whole industry.
Well, thank you all. Maybe you can join me in thanking our panelists, and I wish everyone a successful Posidonia. Thank you.